Friday afternoon. How's everybody feeling?
That was a philosophical ending to the last panel. I feel a little ill-equipped to follow that. So, real-world assets. Thanks so much for being here on a Friday afternoon. I'm Elaine, your moderator. I am the co-founder of Eve Wealth, which is a new digital asset investing platform open to all, but geared towards women. Less than 10% of US women have invested in crypto, and I am on a mission to change that. We have an exciting conversation today about bringing capital markets on-chain. I thought I would let our panelists introduce themselves, say a quick word about what their company does.
I guess I'll start. I'm Pavan Agarwal, and I've been in finance, real estate, and blockchain and AI for a long time. I own two companies, SunWest Mortgage, which my father started since 1980, and Angel AI, which is started in 2012-13. So thank you.
Hi, y'all. I'm Alex Moore. I'm a partner at the law firm of Carrington Coleman, where I practice securities and corporate governance, litigation, and compliance, and got into crypto back in 2013 and launched our digital assets practice group in 2018.
And hey, everybody. I'm Jim Hiltner, co-founder of Superstate, run business development, spent about a decade in traditional finance, and then got into fintech, which these worlds are converging, which is great to see. And at Superstate, we're bringing Wall Street on-chain.
Fantastic. So I wanted to open with a quick fire for each of you. What is the biggest promise and the biggest risk of moving capital markets on-chain, in your opinions? I'll start with Pavan.
The biggest promise is increased liquidity, and biggest risk, which I think is being addressed very rapidly, is the regulatory uncertainty. So if everyone has a blockchain wallet, which most people still don't have, being able to trade fixed income assets, for example, which I'm in fixed income, would be tremendous. And I think the price of credit and debt would go down tremendously. So yields would fall.
I think the biggest promise of bringing capital markets on-chain is increased cost and speed efficiency of transactions. We can finally realize the promise of T+0. And the biggest risk is going to be blockchain failure. I mean, you're talking about a huge volume of transaction data and digital assets. And so hard to realize those promises if you have a network outage when you're trying to process all of that.
I think the biggest opportunity is access. We have a very walled garden system. Although the U.S. is the envy of the rest of the world, not many people can get access to opportunities in very promising projects and investments. And I think the biggest risk, honestly, is that now that the regulatory floodgates are open in terms of having the ability to innovate, is that regulatory capture is also a challenge around that. And so incumbents that are looking to defend their territory might also try to prevent the innovation that is promised in this technology.
It's so interesting you say that, Jim. That's exactly the reason I got into crypto in the first place. I was working at JP Morgan in the private wealth group, and I saw all of these asset classes with the massive asymmetric upside return that I didn't have access to because I couldn't write a seven-figure check or didn't know Mark Zuckerberg's college roommate to get in the next hot deal. But I could invest in crypto. So it's kind of full circle moment that now there is this dream of democratization because of tokenization, which we'll get into in a little bit. I'm actually going to go back to you, Jim, and ask, from Superstate's perspective, which asset classes are most ready for tokenization and what should not go on-chain?
I got to start with what should not go on-chain. Illiquid assets. I think there is an opportunity in the future to build more liquidity around illiquid assets, but because the technology and the ecosystem is still relatively nascent, I don't think that promise can be executed on today. So you look at real estate, and everybody's been like, oh, let's tokenize this building in Fort Worth. Like, who really cares? If there's not a lot of demand on the other side, that you can put it into a vehicle where it becomes liquid and fractionalized. And so I think there's definitely an opportunity for somebody who wants to invest in that building in Fort Worth in the future, but I don't think that that's today. So if I look at like the efficient frontier and you look at like the bottom left-hand corner of this, treasury bills, I mean, that's what have seen the most opportunity or demand. And it's kind of twofold. It's one, because, when the Fed started raising interest rates and people were sitting on a bunch of stable coins, like you had an alternative to earn some yield. And that's where money market funds have gotten a lot of adoption. But also in turn, those stable coins need to back their reserves with assets. And so like at Superstate, we run a large money market fund that has just treasury bills sitting in Bank of New York Mellon. It's as boring as it possibly can get. But we have got, hundreds of millions and soon to be billions of demand because Genius Act unlocked the ability for anybody to build stablecoin. And Stripe acquired a company called Bridge. Bridge has stablecoin as a service. And they announced last week that there's 3 managers of the reserves: BlackRock, Fidelity, Superstate. And the reason why they chose Superstate is because they actually have a lot of programmability. Like they have a lot of technology that they built on top of their stablecoin, and they're like, okay, I got $100 million in from people that want to use my stablecoin. Am I going to go wire that to a JP Morgan account? Like, no, I'm going to keep that as a programmable asset that's going to interact with another programmable asset, which is an on-chain money market fund. And the fact that they're on the same network just makes the settlement happen 24/7, 365. And so liquid assets have definitely had that use case on stable coins and better, like more high quality reserves. And now you're starting to see extension up the risk curve. Equities is the next area that I think is going to have the biggest disruption to Wall Street and the biggest demand on chain.
Yeah, I agree. Building on your who cares about a building in Fort Worth, Pavan, we had an interesting conversation earlier about, to that question, like who cares if it doesn't benefit the end customer? So can you say a little bit more about that and how we try to get them to understand the benefit?
Yeah, so if you're tokenizing capital markets, and consumers still have bad memories from 2008 and so many other things, at the recent bank failures and so forth, and tokenization is another layer of abstraction and more technology. So all it does is add more fear and concern with everyday people who don't know this technology, and they feel like they basically feel like there's some smart guys that are putting the wool over their eyes. So what we have to do is we have to get tokenization and the idea of blockchain in a format that everyone can touch and feel and appreciate it. So for example, why does a dollar bill have any emotional value to people? Is because you could take the dollar bill, go to the local store and buy a piece of candy. So it feels valuable, right? But nobody, I guess now with stablecoins, still not quite there, but people with tokens, if you have tokens in your wallet, you can't buy something with those tokens, right? It hasn't really been there. You can go on exchanges and trade stuff. So if we can build technology that brings wallets to everyone's hands, and where they can have tokens in their wallet and then exchange over the counter. Right? So I could sell this microphone to you, and you give me, an Ethereum for this microphone. It's a very expensive microphone, but if we can do that on a regular basis, and if everyone can have that experience, now suddenly the idea of tokenization in capital markets is no longer scary, and people get the idea. And we need that kind of education and mainstream acceptance of this technology. Otherwise, we're going to overregulate and overcomplicate the whole process.
That makes sense. Speaking of regulation, Alex, as the resident attorney on the panel, how compatible is the current U.S. regulatory framework with fully on-chain capital markets?
So I think you could say for the past 8 years plus, certainly under the Gensler era of the SEC, it's been a big red light. We've had regulatory uncertainty out of the legislature in terms of our lawmaking, and then you've had regulation by enforcement from the SEC, which is, I think, everybody here is familiar with. It's been a huge problem. And now we've shifted from a red light to a yellow light, we're still missing critical legislation. Jim referred to the Genius Act, which is a huge step in the right direction. We have the Capital Market Structuring Bill, the Clarity Act, which passed in the House, but it seems is unlikely to make it through this legislative session, but there's progress being made, and certainly a higher legislative priority than I would have expected. But where we're seeing real leadership right now is from the new SEC under Atkins, where they've established a crypto task force and what they call Project Crypto, where they're really looking to totally shift the direction to make new regulations, new guidance from the SEC that makes on-chain capital markets possible. And I think that that is where, over the next several years, we're likely to see the fastest clarity and the fastest leadership to allow that to happen. And so to kind of round it out and answer the question, I think that it's not that current regulations or laws are incompatible with moving on-chain. It's just that we've been in this era of a gray zone for so long and under a hostile SEC that people have been very reluctant to try because you reach out and you just get your hand burned every time. But now we're in an era where you can have companies like Jim's at Superstate that are actually doing the thing and charting a course forward, working with the SEC to be able to do it. And that is really exciting.
I think the irony is that, like, are the regulations today compatible with blockchains? And if you actually, like, and this is, I'm not a regulatory expert, but you know, if you look back to before we had this very centralized, intermediary-driven capital markets system, which is amazing today, don't get me wrong. You used to be able to, like, take your certificates, which were your shares, and, like, meet somebody on the corner and be like, you got a loaf of bread or a microphone and I'll give you, you know, shares in British Tobacco or, like, whatever it was. You know, the fact that we have DTCC and you have these centralized exchanges and these, like, venues that exist right now is primarily because the technology did not exist to process transactions on a decentralized network at scale. We now have that. And so from Superstate's perspective, we want to, like, I'm a registered investment advisor. I have an SEC registered transfer agent. So to what Alex said, like, everything that we're trying to do is forget the technology. You know, the regulatory environment already exists in terms of how do you disclose financials for a company? How do you KYC investors? How do you ensure that everything is audited and tracked? Like, those three things can be supported with the technology that's there today. We just need to be given the ability to put sand in the sandbox, start to play, and allow regulators to see exactly how this new technology facilitates what is already happening today, but at a global 24/7 scale.
On the question of start to play, I was talking to a friend of mine who works for a large asset manager. So yes, we can tokenize these things, and we are tokenizing these things. If you really want the big guys to start trading these things with each other, how do you get them all to agree on how to do that? What chain is everybody going to use? What is that going to look like? What if JP Morgan wants to use X and somebody else wants to use Y? Like, what does that process look like, and how far away are we from everyone coming to agreement, or if ever?
We are far away from that happening. Let's be real. I mean, you know, and also part of it is because, like, you show me the incentives and show me the results. Like, if you can build a private blockchain and call it DeFi, and you make all the money from being a validator on that network, like, you have less incentive to be on a decentralized ecosystem. So, like, there's still choices being made, like public versus private. Is it Ethereum? Is it Solana? Is it a layer 2? Is it, you know, what does it look like? I think it's going to take a while, but I think what's going to happen is this conversation is going to be a moot point, because nobody is sitting here today, and we've heard this 1,000 times, but, like, when you send, you know, you open up a website, does it say, like, powered by AWS or, like, powered by Google Cloud? Like, no, it doesn't. It's just like, this is, like, bananarepublic.com, and, like, you don't care what the infrastructure is behind it. You get to interact with it. And so it's going to take time for that all to, like, fall behind the wayside or behind the scenes. But I really do think, you know, like, the Robin Hoods of the world are, like, really getting active in this, and they have so much activity on their platforms that they're going to interact with innovative businesses like Superstate that are taking regulated businesses public on chain and giving their access users to it. And how that happens is between the Superstate and Robinhood to figure out, and not, like, you know, for the user to figure out. And once the deals are in a particular network, like, you know, if you could only trade stocks electronically, like, every bank on the planet is going to figure out how to get not on paper and get electronic. And it's the same thing that's going to happen when you go to on-chain as well.
To add to that briefly, I think from a legal perspective, the upcoming laws and regulations are going to gatekeep this to a certain extent. Like an easy example would be, you look at the Genius Act and stable coins. You have to meet certain prerequisites in order to be a legal stable coin. You have to have asset-backed reserves with dollar-to-dollar and T-bills or what have you. But also, and for those of you who are kind of crypto OGs and adhere to founding principles of immutability, you got to have things like reversible transactions. I don't know if everybody knows that if you use USDC and Tether, those are reversible transactions. They can be monitored, and these are the kinds of things that the government cares about, right? And so it may be kind of against our founding principles, but that is what the government is going to require in order to allow and permit sanctioned trading activity on chain. And so that it's not going to answer the question of, are you using the Ethereum blockchain or the Solana blockchain or another one, but it is going to gatekeep and weed out who is able to participate.
Interesting. Pavan, I'm so curious about what Angel AI is up to. I've had a great time meeting some of your team the past 2 days. So you're essentially merging AI and blockchain and tokenizing digital intelligence. How do you see that fitting into capital markets? And is there a world where user data becomes an investable asset class?
Yeah, I mean, user data is an investable asset class. It's the most valuable thing any of us own right now. And that's what Angel AI is doing with the Angel Wallet. It's taking your data and putting it into your wallet and in your own personal vault. And with that, we drive Angel Twins, and that's your own personal AI. So we want everyone in the world to have their own personal AI. And let's talk about why you'd want your own personal AI. So I'll walk you through a simple example of capital markets, finance example, which let's say I'm Mr. and Mrs. Smith, I'm on Main Street, I buy an annuity with New York Life, right? And put $100,000 in an annuity, right? I'm losing a couple of points in fees in that annuity, in that purchase and commissions and so forth. And then all that New York Life is doing behind the scenes is taking that money and buying mortgage-backed securities, a lot of Ginnie Mae, and the right balance of Ginnie Mae securities and treasuries, and some private mortgage securities, and duration matching the annuity with the prepayment curves of those mortgage-backed securities, right? And then they're taking a big slice of that. So why would I do that if I have my US stablecoin in my wallet, okay, put $100,000 in my wallet, and then let the AI run, and let it automatically, and I give it my goal. My goal is I want a low risk yield for the next 5 years and maximize the yield, and it also looks at it has my personal data. It's looking at my spending patterns and my obligations and so forth, and it knows all of these things about me, and let it go out and source, Ginnie Mae securities, source some mortgage backs, source some treasuries, as in the form of tokens, put in my wallet, and let it do it on its own. And I could save a couple of points, right? And I could completely personalize it, right? If I give it to New York Life, I have really no control and no transparency into what they're doing with it. So sorry, New York Life, I didn't mean to pick on you, but you're here.
And also, quickly, because I'm personally fascinated by this, one of your team was telling me about Deepak Chopra's digital twin and how I can pay a subscription to access that whenever I want.
Yeah, that's correct. It's digital Deepak. That's our first version of a twin. It's pretty cool. And now we're working on Twin 3.0, which is completely like a Zoom meeting, fully interactive twin. So you could.
So I wouldn't have to go to a Zoom meeting again?
Yeah, I mean, you don't have to go to a Zoom meeting right now if you don't want to. Right?
I know some people who would say otherwise. Okay, going back to tokenization, I think when we first started hearing about this years ago, there really was this dream that it would lead to democratization, that suddenly you could get a small share in a private equity fund or in a private credit fund, things you couldn't have access to before. But we haven't really seen that happen yet. I'm wondering from the group, A, why you think that is, and B, if and when you think that's going to change.
Well, we have and we haven't, because this goes to the earlier point that you're making, Elaine. Like, in the ICO boom, you look back in 2018, like, you're having effectively public offerings for crypto startups built on a roadmap and a promise that are being sold to retail investors for anyone that can get them. And I don't think it's controversial. I mean, I was saying this in 2018, but I don't think it's controversial to say here in 2025 that those were, illegal, unregistered securities offerings that should not have been offered to retail investors in the public. And so that happens. It continues to happen every day. And each one is different, and some of them may be decentralized, and they don't meet the Howey test, and so on and so on. But the point is, if you're talking about giving retail access to tokenized, effectively securities and investments, you need a regulatory framework that permits that. And that is, I think, a lot of the focus of what we're doing. Some of that has to do with market structure and has to do with whether or not you can have on-chain assets and what form those take. I think, Jim mentioned Robinhood earlier. Robinhood very much on the forefront of kind of fractionalized share ownership as a way to get access to shares you couldn't otherwise buy in whole, or you can also buy options if you're that kind of degenerate. But you also have on the flip side of this. Sure. On the flip side of this, you also have, the definition of an accredited investor to be able to access private offerings. And, that I think is a separate but ongoing issue of, does it really make sense in 2025 that the gatekeeping ability to access a private offering is if you're rich enough? Because the assumption is if you're wealthy enough, you must be smart enough with your investments and you can absorb the risk. And I think that it's time to revisit that and ask whether that really remains true.
I would love to get rid of accreditation rules. Oh, it'd be a dream.
Ask Chris Davis in the audience. He's working on it.
Please, hurry up.
Yeah, I mean, competence over wealth to demonstrate the ability to invest in something. Yeah. I mean, I know a lot of really dumb rich people, and
Same.
I think it does come down to regulation. To go back to your original question, I mean, we launched our money market fund, which has U.S. Treasury bills that have less than 30-day duration. They're the safest thing on the planet. They're in Bank of New York Mellon, which is the biggest bank on the planet. They're audited by Ernst & Young. It's one of the top 4 auditors. I mean, I could go on and on. My parents, as non-accredited investors, cannot invest in that fund because I allow people that opt to hold their shares as a token on the Ethereum or Solana blockchain, means that they have to be highly sophisticated investors. Now, my parents don't know anything about crypto, so they wouldn't choose to take the token, but they can't even give me $10,000 to put in that fund to hold T-bills for them because, up until now, which, we're here like 9 months into the administration, we couldn't get that approved by the SEC to be a registered publicly registered fund. That's changing. But I do think, if I look at the equity space, one thing that really grinds my gears is, I also have friends that have Robinhood accounts, and Robinhood purports to give them, and they try their best, to give them access to IPOs. And the way that works is they go out and they ask for an allocation from the investment banks, and the investment banks say, hey, we like you, but you don't have a house in the Hamptons like our other hedge fund buddies do, and so you're going to get less of an allocation in the IPO. And so what happens is my buddy who's on Robinhood, who wants a $30,000 slice of Circle when they went public, got a $3,000 allocation. And so the 10x more that he would have had in that IPO would have been over $100,000 of a return for his family that he had no access to because he didn't get the allocation of IPO. I think tokenization will democratize access because you don't no longer need intermediaries to distribute securities. You have the ability from a KYC'd, highly compliant, a fully disclosed, registered entity, the ability to match demand and supply through blockchain technology without 1,000 banks and intermediaries and lawyers in between. And that is a very nirvana thing to this audience, but it's happening in Q1 next year. This is happening soon, and stay tuned with Superstate, but there is no reason why you can't connect your wallet, say I'm a legitimate actor, and look at the SEC filings and say, I, as part of this auction, want to go put some money into the IPO and have a better listing price and process than you do with the current market structure today.
Fingers crossed. I don't know, Pavan, do you have any thoughts on the potential for democratization and if it's real or not and how it might get there?
I think AI is a key part of it. I mean, imagine an AI financial advisor that's in your wallet, is in essence. And my vision of this is like everyone is their own central bank. You have in your wallet, you have a basket of different assets from Bitcoin, Ethereum to tokenized real estate, mortgage-backed securities, other fixed income products, all tokenized in there. And the AI, you give it your goals. It also knows it has your personal data. It knows that your kids are going to college in 5 years and so forth. And it just let it goal seek and optimize your portfolio for you. Why would you need to pay hundreds of basis points to intermediaries that don't even do it half right for you right now? But they're licensed and registered, so you have no choice. And also, in that process, if you let the AI manage your wallet for you or work with you to manage your wallet, everyone and part of democratization is education. So your wallet is managing your money and you're seeing the trades that it's doing and why it's structuring the wallet. And you can ask the AI, hey, why did you put so much in Bitcoin and so much in real estate? And it's telling you why. So it's this automatic education in that process.
Yeah.
And we've seen the effect of AI educating people by doing real world transactions. So when people, for example, go into Angel AI and use the credit repair, and the AI is working with them as it repairs their credit, at the end of the process, not only have their credit been repaired, but they're far more educated on credit and managing their credit.
It's amazing. And we are, in fact, out of time. So I think we're going to end it on that note. Well, actually, real quick, one word from each of you. What's changed a year from now?
Sorry, what was
What's changed a year from now? We're sitting here a year from now. What's changed?
a lot. War's over in the Middle East.
Fingers crossed.
No, I think a lot of capital formation will be happening on chain. I think tokenization thus far has been about either wrapping existing stuff, which is lame and never going to really be a cool thing. You've had direct tokenization, which is existing publicly traded, or legitimate assets. I think you're going to see capital raising take a major leap in 2026.
I think a year from now, we will highly likely have new SEC guidance on compliance and what qualifies as a security, what doesn't, and security won't be a scarlet letter. There will be rulemaking, at least in the comment period, to discuss and figure out how you can do these things.
Awesome.
I think another $5 trillion in the GDP of the U.S. economy is added due to AI and tokenization.
You heard it here first. Thank you to our panelists. Thank you,
USA.
America.
Thank you, Elaine. Thank you all.